Let's look at the identified cost method, how we would record returns of inventory, which is always really tricky. So what is the identified cost method? It's where each unit of inventory is physically marked, for example, with a sticker, so it can be individually identified when a transaction occurs. And we need to know the rules for the following transactions here. And so far we've done sales of inventory. So now we need to know, what do we do when there's a sales return and a purchase return? So inventory normally flows in this order. There's suppliers, our business, and customers. Suppliers sell us inventory. We call that a purchase. And then we sell that unit by unit to customers, and we call that a sale. However, this topic supposes that the order of that inventory flow is reversed. So in this case, customers are going to bring inventory back to our business, call that a sales return, and then we will send it back to our suppliers. We'll call that a purchase return. So we need some rules on that, on what to do. So a sales return is when a customer or an account receivable returns inventory they bought on credit back to our business and receives a credit, or what we call a decrease, off their account. And a purchase return is when our business returns the inventory it bought back to the supplier or an account payable, and we're the one getting a decrease off our account. And the reason could be anything. So there's many reasons, but the main ones are usually going to be the inventory is faulty or damaged. It's the wrong size, shape, or color, etc. Maybe we ordered too many, or perhaps the customer simply changed their mind. So that's from a previous topic. What we need to deal with now is we need a rule that when a sales return occurs under the identified cost method, we're going to apply the rule that the actual unit is identified. What are we talking about? Let's have a look at this example. Let's work in a complicated example all the way through. May the 3rd, purchased 5 units for $44 each, including GST, and paid with cash, receipt 504. So we get the GST out, divide by 1.1. We've got 5 units in on May the 3rd, receipt 504, 5 units in at $40 each for 200 as a total, and that's our balance. We're going to put pink stickers on those boxes so we can identify those products later on, those $40 units. On May the 5th, we sell 3 units for $100 each plus GST on this invoice number. The inventory had pink stickers, so this is going to be an out. We've got May the 5th, invoice CC126, 3 units out. They each had pink stickers, so they're $40 each for a total of $120. That should leave us these two here at $40 each for a total of $80. May the 11th, we buy more chairs from Wholesale Chairs, 3 units for $50 each plus 10% GST, invoice A34. So we do the date, the details, which is a document number, and this time we've got 3 chairs coming in because it's a purchase for $50 each for a total of $150. We're going to put yellow stickers on these ones. So now the balance is we've got 2 at $40 for $80, that's these 2 here, and 3 at $50 for a total of $150 here. Then May the 14th, credit sale, 2 units for $110 including GST on this invoice number. 1 chair had a pink sticker, the other a yellow sticker. So just remember with a sale, this actually see here on May the 5th as well, it says 3 units for 100. That's actually irrelevant. We don't need that for the inventory card because an inventory card just deals with costs. So this 110 and 100, we'll need that for something else, but we actually don't need it for the inventory card. What we do need to figure out though is which 2 chairs did we sell? And it says 1 chair had a pink sticker, so that's 1 out at $40. And the other had a yellow sticker, that's 1 out at $50. So that now leaves us with 1 at 40 here and 2 at 50 here. And then a customer returned 2 faulty chairs and was given a credit off their account for $200 plus GST. And the problem here is I can't tell which of these 2 purchases, like which customer brought their inventory back, because it's going to change whether we give the refund at $40 for all of them, or is it 1 at 40, 1 at 50, because they're bringing 2 chairs back. So as that stands, I can't answer that question. So the question must give us something that we can use to identify which of these purchases it was. So let's add that in and say the customer showed invoice CC126 as proof of their original purchase. So it's actually this purchase here. This is the sale that's being returned. It's these pink chairs. So the 2 chairs that are going to come back, first of all, we'll do the date. That's going to be these ones here from May the 5th. We'll do the date. All right, credit note 11. It's these 2 chairs here. So the customer bought 3 and they're returning 2. 2 coming back in at 40 for a total of 80. And now we've got 3 at $40. That's those there. And 2 at 50 there. So that's how we deal with a sales return. We're identifying the actual unit. What we now need to do is record that in the general journal. So there's our transaction. There's our general journal. And just going back to an earlier topic, a general journal for a sales return is very difficult. So the first thing is we've got a sales return ledger, which is a negative revenue. We'll do a debit to that of 200. And we know that because it says the customer was given a credit off their account of $200 plus GST. So we'll debit GST clearing to offset a credit we made at the time of the sale, and then we'll do a credit to accounts receivable to the customer's name. We don't know the customer here, but whatever their name was, they would have had a ledger. So that's easy. That's the sale amount. What is tricky about this one is we need to undo the cost of the sale as well, and we do that with a debit to inventory and a credit to cost of sales, but we're not given that. And the whole purpose of knowing the rule for the sales return is that we can now go to the inventory card and go, well, what amount are we going to use? We're going to go down here, and we're going to use this amount here, $80. So that is going to be the number we put there and there. So now we know how to do it with the sales return. But we also better do a purchase return, and the rule's a little bit different. It's actually simpler. It takes all the sort of guesswork out of our hands, because the rule is the cost is determined by the supplier on the credit note. They tell us what the amount is. You don't go into a shop and say, I want a credit for this amount. The supplier or the shop tells you what the credit's for. So let's deal with the exact same transaction. We're going to have the exact same info up to May the 15th. So we're going to have 5 units at $40. Then we sell 3 of those, so they go out. Then we buy 3 at $50, and then we sell 2 of those, and that's where we left it with the previous example. So what have we got left? We've got 1 at $40 with a pick sticker, 2 at $50 with yellow stickers. And then instead of a sales return, let's deal with this one. We identified that one of the chairs in inventory was not the model we had ordered, it's the wrong one. So we return it to the supplier on this credit note here. Which one did we return? Well, we can't tell really, because if you look at this, at the moment in inventory, we've got 1 pink one and 2 yellow ones. Which one was the wrong one? Well, we can't answer that with that question as it is. So the question, must tell us. We don't really need to think, because the supplier will tell us what the credit is. And let's put that in. Say the supplier gave us a credit of $50 plus GST. So it must be one of these yellow ones. One of these yellow ones is what we're sending back. So we do the date. We write credit note here for the details. And it's an out of 1 yellow chair at $50. So now that leaves us with 1 at 40 and 1 at 50. And the whole point of that was now we can do the general journal. So there's the transaction that happened. Here's our general journal. We do a debit to accounts payable. We put the supplier's name. We didn't have it for this question, but they gave us a credit of $50 plus GST. Their name would go there. What we didn't know was, what's the credit amount here? Well, that is the unit we return. That's an out. Outs make inventory go down, so that goes there. We'd also need to do a credit to GST clearing of $5 to offset the earlier debit we made at the time of the purchase. And that's it. So now, to summarize, we kind of know everything about returns. Here's the rules for valuing inventory under the identified cost method. We already knew how to do a sale. And what we just learned is with a sales return, the rule is identify the actual unit. But with a purchase return, the rule was slightly different, and we don't even need to think. The rule is just the cost is determined by the supplier on the credit note.